right? So maybe in the terminal value calculation, we look at what's going to happen further out. Yeah.
A question on the ongoing versus ongoing.
Okay.
Help me with a measure that you're comfortable with and a range that you're comfortable with. And if I'm a business owner and I own a job, but I've got 5 years of runway, and I know I can do some things to build that value and turn this into a sustainable organization. What am I looking at in terms of what's that worth to me to do that?
Well,
Can you repeat the question?
when I do valuation work, I look at the liquidation value or the book value relative to the discounted cash flows.
What was the question?
So I can look at the spread and try to value it that way.
Right, can you repeat the question?
Oh, yeah. So the question is, if I got it right, so if I have a company that is not an ongoing concern, but I've got a 5-year window where I can increase the revenues of that company and get it to a point where it may be more marketable. What is the trade-off between an ongoing concern versus this non-ongoing concern? So where is that? What's the value gap between these two? And I would have to look at historical data, but the way that I would get at that is to say, let me look at some companies that were ongoing concerns and value them, and then look at the book value or the liquidation value, or treat it as if it were not an ongoing concern, and look at the spread of value. And somehow, that's how I would have to get an estimate of what that option value essentially is worth. Yeah?
Do the inputs depend on who's ordering the valuation?
I'm going to give you my answer, and I'll give you the truth. The reality is that, yes, it does matter. You can look at any valuation. I don't care who did it. You can look at any valuation, and you tell me who did the valuation, and I can tell you the direction of bias of the valuation. Over the years, I played around valuing Microsoft. I particularly don't like Microsoft very much. So they got great products, but just, there was something about them that I didn't like a whole lot. So at every decision node, are they going to do this or are they going to do this? I always went with the worst case scenario. My value was bad. Somebody on the other side of the table at Microsoft probably said, yeah, we expect the best outcome. Therefore, in our cash flow projections, it's going to look here, and my cash flow projections are going to look here, and you're going to see a difference in the value based on the bias, right? My job as a consultant is to hit it right down the middle. So I like to stand by my valuation work, and I represent my valuation. So I'm going to give you my best case estimate and try to the best of my ability not to be influenced one way or the other. What you do with that is your choice. But yeah, bias absolutely creeps into almost every valuation because there's so many inputs that we have to make estimates on. And how you feel about a particular input is going to affect how that valuation comes out.
If you're doing a valuation for marketability of a private company for purposes of taking it to market versus doing the valuation for the bank who's looking at financing the deal after it's been in the market.
Right. Yeah. Well, like I said, I'm going to value it for what I see it as being worth. I'm going to look at the cash flows. I'm going to look at relative, valuation measures, and I'm going to put a number on the company. That's where it's at. And then how you want to massage those numbers and how you want to present them, we can talk about how best to present them. I can say that this is my base case estimate, and this is my good case estimate, this is my bad case estimate. I can put that spread of values in there. But for internal purposes, I'm fine. We can talk about different scenarios and how to, how we can, increase the value. And that's kind of the last part of what I want to talk about is, trying to manage value. So how can we increase the value of the companies? And so I got 4 tips that, may not be, all that enlightening, but hopefully you get something out of it. So the first place, if we want to, if we have a client that is in the position where they want to sell the company, the first thing we want to look at are the assets in place. So, and this is assuming an ongoing operation. This is the free cash flow calculation. So you can see areas where we can work to try to enhance the value within, with the assets that are in place. So can we increase the margins? That's going to increase the free cash flows. It's going to increase value. Are there assets that we have in place that are actually a drag on the free cash flows? If so, we can I try to identify those and get rid of them. Again, it's going to increase the cash flows, increase the value of the company. Make attempts to the greatest extent possible to reduce taxes. We're kind of stuck by legislation in that regard, but maybe moving the income to lower tax locales. And we see a lot of this stuff happening right now. Public companies are going overseas for more favorable tax treatment. With respect to capital expenditure, maybe in the past there was an overinvestment in capital expenditures. Can we live off of some of that overinvestment that we've had in the past? And then the working capital accounts, can we get better inventory management? Can we tighten up our credit policies? All of those directly affect the free cash flows. And if I hold the discount rate constant, it should increase value. Look at the length of the growth period of the company. So the thing that's going to drive the growth period of the company is the competitive advantage. Look at the existing competitive advantages the company has in place and see are there areas where we can develop new ones. Brand name, can we build up brand equity? Patents, that's the legal protection portion of the patents. Can we make it such that our product induces high switching costs to customers to make them more loyal to us? And what cost advantages can we derive? Those are areas where competitive advantage can be created. So we can kind of look at all those to see how we might be able to increase the growth trajectory of the company. The third way, if I don't change cash flows at all, but I reduce the discount rate, I'm going to mechanically increase value. So are there things I can do in the capital cost, the way the firm is financed, to increase value? Change the financing mix. Debt is less costly than equity. It imposes different constraints and different risks, but it's less costly than equity financing. So can we change that debt-equity mix? That alone can result in a reduction of the capital cost. Can we reduce operating leverage? In the top part of the income statement, can we reduce the operating leverage? More flexible wage contracts, some outsourcing. For those that aren't familiar with the term operating leverage, it's how sensitive is EBIT to a change in sales. So that's how we measure operating leverage, and basically it deals with the firm's fixed cost structure. So are there things in the fixed cost structure that we can work on to try to reduce the amount of operating leverage, because that has a direct bearing on the equity costs that we have to pay to equity investors. Can we reduce the firm's business risk? This beta measure that we use to try to estimate the cost of equity captures some element of business risk. So can we do stuff to reduce the business risk that the firm faces? Make our products or services less discretionary. In other words, competitive advantage, these barriers to entry. Can we create barriers to entry that are going to reduce the firm's business risk? And then with respect to the debt, we can match the debt to the assets through various derivative type securities. And try to reduce the debt costs as well. Last big topic that I want to talk about is growth. So growth comes from fundamentals. So when we look at growth rates, growth has to be a function of how efficiently the firm operates and what kind of cash flows the firm has to reinvest, right? So two ways that we can measure, try to estimate growth rates. Return on equity is an efficiency measure. This 1 minus the dividend payout ratio is like what's left over from that income after the firm pays out dividends. That goes into the retained earnings on the balance sheet. So growth can be a function of this return on equity, this efficiency measure, and the amount that the firm has to reinvest back into the company. These are equity cash flows, and then the corollary for free cash flows is this reinvestment rate, where we look at the sum of capital expenditures and working capital investments, and we standardize that by after-tax operating income. So this is our efficiency measure. Well, I'm sorry, this is our amount, and then this is our efficiency measure, the return on capital. Kind of the corollary to return on equity. The return on capital is the after-tax operating income divided by the capital structure of the firm. So when you think about growth for companies, growth has to come from fundamentals somewhere. We just don't take numbers. So the last thing I think that we can do to try to enhance value is to try to increase the expected growth. Reinvestment rate, reinvesting in more projects and making acquisitions can drive that. Efficiency, increase the capital turnover and increase operating margins. And then I'm going to close, and I'll be glad to take questions, but I'm going to close with this growth warning. Right? Not all growth is good. Growth only increases value if the return on capital exceeds the cost of capital. So in other words, is this return on capital greater than the weighted average cost of capital, or the corollary, is the return on equity greater than the cost of equity? The landscape is full of companies, good companies, that grew themselves into bankruptcy. If the firm grows too fast, then these ratios get out of whack and they actually destroy firm value. So growth can be good, it can be a value driver, but can also be, it cuts both ways in some cases. That's what I got. I went a little bit over, but if there are any questions, I'll hang around for a while, or
I think we have time for just a couple of more questions. Do we have any more questions?
Yeah.
Besides helping a business with the valuation, does your company also help with the sale?
We don't do the transaction. We'll help you get ready for it, but we can put you in touch with folks to help you with the transaction.
And explain to me how you charge for your services.
Early and often.
Is it based on a percentage of the value, a percentage of the sale, an hourly rate, a fixed rate, or how do you do that?
Yeah, it's a fixed rate. I'm worried about contingency type engagements because that may induce a bias into my valuation. If I'm compensated based on the value of the transaction, it induces a bias into my valuation. So it's a flat rate. If there's other, ancillary consulting stuff, we can work out an hourly rate. And valuations come in different flavors. So we can do a full-blown valuation would be akin to like an audited financial statement. We can do what we call a calculation, it'd be more like a compilation. Obviously, one has just more detail, more and something you can take to the IRS that that we'll sign off on. The other one is what's the company worth, internal purposes type valuation. So if you're in a situation where you're looking at selling the company, selling companies are kind of like selling houses. Real estate agents are going to tell you, your house is worth $1 million, and then somebody's going to come in with an offer of $600,000 and say, I think you should take the deal. Well, they induced you into thinking that your house is worth more, so that you're going to sell it. Same thing happens with company valuation, believe it or not. So, you get an investment bank or a business broker that's going to look at your company and say, oh, I think you can get this in the market. If you sign an engagement, and they're going to, it's possible. Not that it happens all the time, but it's possible. So where we can come in, I think, is just to give you a sanity check so that you can make sure that that your other advisors are, shooting straight.
Thank you.
Hey, Greg,
Yes.
do you guys ever do fairness opinions?
Yes.
Yep.
But it's so litigious now that it would have to be a case-by-case basis what we take on and what we don't. But if you want to put us under your insurance umbrella and indemnify us, I'm fine giving the number. But yeah, we can do it. It's just a more detailed valuation.
Greg, thanks a bunch. Just a couple of quick housekeeping items. Our next and last VCF Presents for 2014, if you want to put it on your calendar, is November 20th. I want to thank our partner, Williams Mullen, for the wonderful venue, and I'd like to lastly thank each and every one of you all for attending this morning, and hope you have a wonderful day and a terrific rest of your week. Thank you for coming.